It starts with a number. $61. Not per gram, not per kilo, per ounce. In March 2026, the same month, the Reserve Bank of India raised rates for the third time in 6 weeks, and food inflation spiked to 12%. Indian bullion dealers in Chennai, Surat, and Mumbai were offering physical gold at a $61 per ounce discount to the government's official domestic price. Let that sink in. The official price already includes a 6% import duty and a 3% sales tax. Yet on the street, people were paying more to get gold faster, outside the system. Why? Because they weren't buying jewelry. They weren't building portfolios. They were buying money. Right now, in Coimbatore, schoolteachers accept tuition in 1-gram coins. In rural Tamil Nadu, landlords list rent as 2.5 grams per month, not 18,400 rupees, because the rupee lost 22% of its purchasing power in just 18 months. In Mumbai's Dharavi market, vegetable vendors recalibrate daily wages twice a day, quoting pay in grams beside their spice sacks, not rupees. When rice sellers start pricing sacks in grams instead of currency, that's not folklore. That's function. That's gold acting as a unit of account, the thing you use to set prices, and a medium of exchange, the thing you hand over to settle debt. That $61 gap isn't noise. It's a live wire. A real-time, street-level signal that citizens are already conducting commerce in gold, not as a hedge, but as currency. And India isn't alone. In Vietnam, gold smuggling surged 40% in 2024, not to dodge tariffs, but to exploit a widening gap between local and global prices. Smugglers moved gold across the Chinese border on motorcycles, melted it down in Hanoi backrooms, and flooded local markets, creating parallel demand for US dollars to buy that gold. That drained Vietnam's foreign reserves, weakened the dong, and triggered an 18% collapse against the dollar in under a year. Officials didn't blame trade deficits or sanctions. Bloomberg reported their explicit warning. Smuggled gold was causing exchange rate distortions and hurting the economy. Translation: uncontrolled gold circulation was destabilizing the currency itself, not as a future risk, but as it happened. Then there's Turkey. In 2023, amid 80% annual inflation and a collapsing lira, the Turkish central bank sold $12 billion worth of gold directly to citizens. Not to banks, not to funds, to individuals walking into branches with cash. But here's what never followed: no gold-backed loans, no gold-denominated bonds, no payment licenses, no deposit accounts, just physical metal, handed over like emergency cash because people needed something stable to transact with right then. It wasn't financial inclusion. It was monetary triage, a state admitting, in real time, that its own currency had failed as a medium of exchange. 3 countries, 3 crises, 1 unmistakable pattern. Gold isn't waiting for permission to function as money. It's already doing it in wedding dowries converted to wage payments, in gold gram scales at Chennai tea stalls, in smuggled bars melting into local supply chains. And the moment citizens begin pricing rent, rice, and wages in grams, not rupees, dong, or lira, central banks face an existential choice. Either surrender monetary control, or quarantine the threat. They chose quarantine, but you can't quarantine something that's already circulating. So the question isn't whether gold is becoming money. It's whether you've noticed it already is, and what happens when the quarantine fails. That $61 gap didn't appear by accident. It's the pressure valve on a system designed to let gold in but never let it circulate. India doesn't just regulate gold. It engineers its monetary irrelevance layer by layer, law by law. Take the June 20, 2025 ban on gold-infused chemicals. On paper, it targeted colloidal metals and certain chemical compounds. But the Reserve Bank's internal circular leaked to Kidco News was explicit. This was about closing a loophole where gold entered the country disguised as laboratory reagents. Gold chloride solution, gold nanoparticles suspended in glycerin, shipped as research-grade catalysts, then reduced to pure bullion in small-scale refineries across Gujarat and Kerala. Not for jewelry, not for dentistry, for liquidity. Because when the rupee wobbles, converting dollars into gold grams via chemistry bypasses forex controls entirely. So India didn't ban a substance. It banned a monetary conduit. Here's how it worked. a trader in Dubai would ship 20 liters of gold chloride solution amber liquid in unmarked drums labeled industrial catalyst. Customs in Mumbai flagged it under routine chemical screening, but the paperwork cleared it as non-monetary. Within 48 hours, it reached a refinery in Navsari. There, a simple reduction process turned that solution into 18 kilograms of 99.99% pure gold worth 10 rupees and 20 paise crore, fully untraceable, fully spendable in grams. No bank report, no forex declaration, just physical gold, ready to settle rent, pay wages, or hedge against tomorrow's devaluation. In March 2025 alone, Customs seized 42 kilograms of such solution, enough to produce 38 kilograms of pure gold, equivalent to 21 rupees crore in instant, off-grid liquidity. Health regulators issued the press release, but the enforcement teams came from the Foreign Exchange Department. Then there's the 2017 export ban still in force on gold products above 22 carats. Bloomberg reported it bluntly, to plug trade loopholes. What loopholes? Simple. Citizens would buy high-purity gold domestically, export it legally as jewelry, sell it abroad for USD, and bring the dollars home, effectively converting rupees into hard currency outside RBI oversight. That's not trade. That's monetary arbitrage, and India shut it down cold. Consider a Mumbai trader with 5 rupees lakh in cash. She buys 100 grams of 24K gold locally, paying the full 9% tax. She ships it to Dubai as temple ornaments, declares it at customs, pays minimal export fees. There, she sells it for $14,200, converts to USD, wires home. She's just turned 5 rupees lakh into $14,200, bypassing the RB's $250,000 annual forex limit, and done it using gold as a currency bridge. The 22-carat threshold isn't about purity, it's about fungibility. Lower carat jewelry is bound to design, harder to melt and resell fast. 22K plus is near bullion grade, instantly convertible, instantly portable, instantly monetary. And consider the tax architecture: 6% import duty, plus 3% sales tax. That's baked into the official price, yet the $61 discount persists. Why? Because that gap isn't about taxes. It's about access. Official channels are slow, documented, and traceable. The parallel market delivers. Gold now, in grams, unrecorded, usable today to pay rent, settle debts, or hedge wages. The discount isn't avoidance. It's the premium citizens pay for monetary functionality, something the state deliberately prices out of existence. You don't need a bank license to accept gold grams for rent, but India made sure you can't legally record it. Street-level dealers in Chandni Chowk now quote daily gold-rupee exchange rates, updated hourly, posted on WhatsApp groups functioning exactly like forex boards. And the RBI's own 2024 Financial Stability Report buried a footnote naming unrecorded gold liquidity as a systemic transmission risk to monetary policy, meaning when gold moves outside the system, inflation forecasts break, interest rate signals get muffled, and the rupee's stability unravels. So when India restricts gold chloride like contraband, not because it's toxic, but because its ester is convertible, it's not regulating chemistry. It's regulating money. Every ban, every tax, every restriction is a surgical strike against gold's ability to serve as unit of account, medium of exchange, or store of value within the rupee economy. This isn't protection. It's quarantine, codified, calibrated, and quietly enforced. India built the cage, but Turkey didn't just build one. It handed citizens the keys and locked the doors behind them. India built the cage, but Turkey handed citizens the keys and locked the doors behind them. Not with laws, not with bans, with silence. In 2023, as Turkey's inflation hit 80% and the lira lost half its value in 6 months, the Central Bank of the Republic of Turkey did something unprecedented. It sold $12 billion worth of gold directly to citizens. Not through brokers, not via ETFs. At bank branches, in grams. People walked in with cash and walked out with physical bullion. On the surface, it looked like empowerment, like trust, like financial inclusion. It wasn't, because while gold flowed out of the central bank's vaults, nothing flowed in to support it as money. No Turkish bank offers gold-denominated deposit accounts. No sovereign bond is indexed to gold grams. No commercial lender issues gold-backed loans, not for homes, not for businesses, not even for working capital. And the central bank issued exactly 0 payment licenses, no digital gold wallets, no gram-based invoicing platforms, no settlement rails. That's not oversight, it's design. When citizens hoard gold grams as millions now do, they're holding savings, not capital. They can't deposit that gold to earn interest. They can't pledge it to secure credit. They can't use it to pay suppliers or settle invoices because no system recognizes it as a valid instrument of payment. Gold circulates as emergency cash, dense, portable, stable, but it stops there. It never enters the financial bloodstream. That's quarantine by omission. Consider the numbers. $12 billion sold in 1 year, yet 0 lira of gold-backed credit created. The central bank's gold reserves rose because it bought globally and sold domestically. So gold entered the national balance sheet but was deliberately excluded from the financial plumbing. No gold-denominated interest rate exists to compete with the CBRT's policy rate. No gold-based money supply expansion is possible. No transmission channel for gold to influence inflation or interest rate expectations because it has no channel at all. This isn't accidental. The Turkish Banking, Regulation and Supervision Agency's 2024 annual report lists 0 newly licensed financial products tied to gold. The CBRT's financial stability reports make no mention of gold-backed instruments, not as risk, not as opportunity, not even as a category. Silence, in this context, is policy. A small Istanbul textile exporter bought 50 grams from the central bank in late 2023. In early 2024, she tried to use it as collateral for a loan to buy new looms, rejected. In mid-2025, she tried to pay her dye supplier with a gold gram voucher, refused. No bank, no fintech, no clearinghouse accepts it. There is no infrastructure, only inventory. So gold functions as a store of value, yes. As a hedge, absolutely. But as a unit of account? No one prices fabric in grams. As a medium of exchange? Only informally and always at friction, melting, assaying, negotiating purity. As capital? It sits inert. That's the operational quarantine, permitting gold's physical presence while forbidding its financial integration. It's monetary. Triage, stabilizing demand without enabling function. Handing out life rafts but dismantling the docks. Turkey didn't outlaw gold money. It starved it of infrastructure. It allowed circulation but blocked conversion. It welcomed gold onto its balance sheet, and barred it from the economy's arteries. And that brings us to Vietnam, where the quarantine isn't about control. It's about survival. It's March 2024. The Vietnamese dong is collapsing, down 18% against the US dollar in under 12 months. Inflation is accelerating, import costs are spiking, and officials aren't blaming sanctions, trade deficits, or capital flight. They're blaming gold. Bloomberg reported it plainly. Smugglers were exploiting a widening gap between domestic and global gold prices, buying cheap abroad, flooding local markets, and triggering exchange rate distortions that were hurting the economy. Not as theory, not as risk, as fact unfolding in real time. That 18% dong collapse wasn't abstract. It was measurable, material, and monetary. Every kilogram of smuggled gold carried with it an implicit demand for US dollars to buy that gold offshore, to pay bribes at the border, to settle black market trades. That demand drained Vietnam's foreign reserves that back the dong's value. Less reserves, weaker currency, higher import prices, more inflation, a self-reinforcing loop with gold at the center. And the smuggling wasn't marginal. Kitco News confirmed a 40% surge in gold smuggling. In 2024 alone, much of it across the Chinese border, on motorcycles, in vacuum-sealed bags, melted down in Hanoi workshops within hours of arrival. This wasn't about evading tariffs. It was about arbitrage, pure and simple. When domestic gold traded at a 12% premium to global prices, smugglers didn't just profit. They destabilized. So Vietnam didn't wait for a crisis. It declared one and responded with surgical force. In April 2024, the State Bank of Vietnam and customs authorities launched a coordinated crackdown not on general contraband, but on gold specifically. Seizures spiked. Border checkpoints added gold detection scanners. Prosecutors filed charges under Article 188 of the Penal Code, smuggling of precious metals, carrying up to 15 years in prison. This wasn't revenue enforcement, it was currency defense. Then came the 2025 gold market reform, widely mischaracterized as liberalization. Bloomberg's September 2025 report clarified its true intent: to reduce currency volatility and narrow an outsized gap between domestic and global prices. In other words, shrink the arbitrage window that made gold monetary. Because when gold trades at a persistent premium, people don't just hoard it, they price in it. They settle debts in grams. They hedge wages against its stability, not the dongs. That undermines the central bank's ability to control inflation, set interest rates, or manage exchange rates. So Vietnam's reform wasn't deregulation. It was reassertion state control over pricing, over supply, over the very conditions that allow gold to function as money. Its goal wasn't to enable gold-backed finance. It was to remove gold's monetary incentive completely. And unlike India or Turkey, Vietnam isn't accumulating gold reserves. Fred data shows its holdings have remained flat since 2022. This isn't about strategic diversification. It's purely defensive, aimed at preserving currency sovereignty. No gold-backed bonds, no gold-denominated loans, no payment licenses, no central bank sales to citizens. Just one unambiguous priority: keep gold off the streets, out of the forex markets, and away from the dong's value. Because when gold sets the price of rice, rent, or wages, when it dictates the dong's exchange rate, monetary sovereignty is already lost. Vietnam didn't join the gold rush. It declared gold a threat and quarantined it as such. Not with tariffs or taxes, but with seizures, prosecutions, and price controls. Not to suppress wealth, but to defend the currency. This isn't about gold's price. It's about who controls the value of your money. And in Vietnam, that control is non-negotiable.